Considerations for selling put options is what we will be talking about in this video, ladies and gentlemen. At the 30-second mark of this video, I'm going to leave you a little linky poo right up here that will allow you to watch a video that tells you the unfair advantages, boom, there it is, of selling cash secured put options. I put it at the 30-second mark, so it'll be really, really easy. And at the 1-minute mark, there is going to be another link to this YouTube playlist right there. It has 5 videos in it. If you watch that, it should put you in a position. Get ready, it's going to pop up right there. Boom. See it pop up? Bam, right there. After watching that, you should theoretically be in a position to start paper trading. Oh, paper trading. Let's go over the disclaimer here about paper trading before people start wetting their pants. So number 1, this is not financial advice. The ticker symbols that we will cover in this video and all the videos that I put on YouTube or put anywhere else or in writing, anything like that, it's not financial advice. It's for demonstrative purposes only. We're going to be using these ticker symbols as, to explain the mechanics of things. I hope that I can help you, inspire you, and guide you to a path of learning how to make suitable financial decisions for yourself, thus not needing to trust the suspect opinion of others. Hey, if you're the type of person that wants to trust the suspect opinion of others, no problem. If you're in the U.S., that's how they have cultivated this country, for everybody to look to some other celebrity type people to tell you what to do. But if you don't really like that, like myself, you want to be able to make financial decisions for yourself, then good for you. All right, so this is not financial advice, educational purposes only. La-da-da-da. Paper trading. I know, I said it. I said, hey, once you got a theoretical idea of what's going on, begin to paper trade it. Nobody wants to do it, la-da-da-da. But for some reason, before you hop in the ring with an amateur boxer, for some reason, you don't mind doing simulated practice then. Why is that? Why is it that you're willing to take real broken nose risk with your money without doing simulated practice, but you're smart enough not to jump in the ring with an amateur boxer without some simulated practice? Why is that? Now, I don't know if that's you, specifically. Obviously, I don't know you. You don't know me. But generally speaking, people get their lacy panties all in a bunch about paper trading. It doesn't give you the real emotion. No poopy, Sherlock. That's the whole point. You don't want to be dealing with, when you're ready to deal with real emotion, you don't want to be trying to figure out what a jab is. You don't want to be just trying to figure out how to head movement when you're actually in the fight. You want to figure out head movement before you're in the fight so you can deal with the emotions while you're fighting and, do the mechanical stuff naturally. Same thing with trading. So I am supporting your decision to get a paper trading account and practice. All right. We're going to get into these different considerations. And these considerations will begin like this. Number 1, how many stocks should you be doing this with? Have you ever heard of this? You can be a mile wide and inch deep, or an inch wide and a mile deep. Hey, it's up to you. These are just considerations. However, what I like to do is I like to focus on a handful of stocks that I'm going to be trading. And if you're a beginner, then it might behoove you to become an inch wide and a mile deep. So for example, if you get familiar with one stock, especially just in the beginning, you get real familiar with one stock, whatever stock that is, then you really learn the movement of that stock. The analogy that was first given to me by the great Phil Grande back around 2012, I remember Phil talking about surfing. And Phil lives in Florida, so he's talking about surfing. I live in Hawaii, so I hear people talking about surfing. To tell you the truth, after I got Vana in my foot one time, that pretty much ended my surfing career. So Phil was saying that, when you go to the same surf spot all the time, you start really getting to recognize where the waves break and all this stuff. But if you surf at a bunch of different spots all the time, you don't necessarily pick up on those subtle changes of the waves. So if you want to dial in one stock, I would think that's kind of smart, especially in the beginning. If you want to put all your focus and you want to be an inch wide and a mile deep on one stock and really know the personality of that stock, that is something to consider, right? And then this is the nice thing. As my first foreign language I learned was German in high school, and as my German Herr Helmus instructor told me, when the first language you learn is the hardest, but your second one will be easier because you've learned the skill of learning a language. So you can take that into consideration here. I think it does have some overlap, that the first time you really learn the personality of a stock, the second one, if you want to add on, like maybe you work with a stock a month, 3 months, 6 months, a year, whatever you feel like. And then when you add that second one, you're probably going to be picking up the personality of it a lot faster. So that's the first consideration that I want to bring to your attention. That is a decision that I believe you should make, of how many stocks you want to deal with. Understanding the wider you go, the more shallow it's going to be. The narrower you go, the deeper it'll be. Another consideration is the volume of the underlying asset. So for example, right now we're looking at the S&P 500 via SPY. And let's just pull up volume this way. So this is Yahoo Finance. Right now I'm not signed in. I don't pay for Yahoo Finance, but I do have like a free account set up. You can do that if you want, or you can just not sign up and use it for free. The value of having an account set up is you can, I think, create some watch lists and stuff like that. And so since it's free, if you're not super paranoid about, they're going to steal my information and all that type of stuff, then I would just create one. But let's take a quick look at SPY, this ETF of the S&P 500. We can see right here the last trading day was a little over 85 million shares traded, and on average volume for this stock is a little under 80 million shares. So let's contrast that with RXT, which is a retail ETF. Look at this. Big difference, right? Big difference. But this is still pretty liquid. 5 million shares, 5.5 million shares traded on average. What would be a stock that doesn't get a lot of, hardly gets any volume? I do know some, and I'm not going to share those because I don't want to somehow be in a position of, like, quote unquote giving financial advice. And but you need to take these into consideration and figure out how much volume you want your underlying stock to be. Back in the Invest Tools course, I think it was Invest Tools, they were saying 500,000 or more. I've heard some people say that they're okay with 300,000 or more. I've heard some people say 1 million or more. So there's a lot of stocks that will trade 500,000 or more, 1 million or more. So you don't have to be messing around with stocks that are only like 10,000 shares traded, or these low, illiquid stocks. The more liquid the stock is, it's basically telling you how readily people are trading shares of it, and it can come in handy for making transactions on that particular stock. So, you know, you make your decision for yourself, but a good rule of thumb would be $500,000 or more, $1 million or more. You decide what you want to do. Another consideration is what sort of liquidity or volume on the option contracts do you want to go with. So just like we were just looking at the volume, shares traded of the underlying asset, we can also look at the volume or contracts traded of the options on your underlying asset. So right now I've got SPY here. We'll go over here and let's go at 33 days, a little bit over a month. We're gonna go down here to where around the in the money, out of the money spot here, and I know that because look, this is black, this one's black, this is that bluish color, this is a bluish color. This is on the put side, this is on the call side. So this black part's in the money, pardon me, this black part's out of the money, this bluish part's in the money, and vice versa, in the money, out of the money. And if that's a little confusing, you need to know more about that. You're seeing this option chain and you're like, oh, what is all this stuff? Then go back and watch that video when this is done. Watch that playlist. It'll help you out with these terms and kind of get you more up to speed with reading option chain. So right here, I've got open interest and volume. Volume is the amount of shares traded, contracts traded in the last trading day. And then the open interest, I forget the timeline of that, but I think it's like maybe like a month, or I forgot. I honestly, I don't remember. I should look that up. But between these two, it really gives me an idea of how liquid this contract is, or the contracts on this underlying asset are. So we looked at we're looking at the SPY. We see we're at a little bit over 2,000 contracts traded last day with an open interest of 600. So you scroll down here, we're in the almost 1,000 here, but we're definitely in the hundreds, right? 3,000 here. I don't see anything that's less than 100. Right, some of it's less than 100 over here. Now let's compare it with, again, XRT, that retail ETF. Still looking at the same 33 days to expiration. Look at this. Wow. Look at that. Look at all those zeros under open interest. All right, it was hundreds with the SPY. Look at this. Right, really just no liquidity. No one's really trading these contracts. So it's probably pretty difficult to trade in and out. Not impossible, but if you want what are you going to do? Where are you going to have your cutoff line? How much liquidity do you want to have in your contracts? I don't particularly remember any courses or hearing anyone that like I've turned to learn saying a certain number. So what can I help you? What can I do with that? Or how can I help you with this? I would say like if possible, you know, if you can get something that's like in the hundreds, or maybe at the lowest. Like for me, I want to have much interest in this. Generally speaking, I want to have interest in this sort of that sort of liquidity. But this is XLF. This is ETF for the financial sector. Right? This doesn't look as good as SPY. Doesn't look as good. But I have in this paper trading account. Sometimes I use XLF as an example. How about XLK technology ETF? Looking at the same 33 days to expiration. Right. Not much going on. Maybe there's more of a reason there. So I would say if you can get anywhere like kind of in the 50, maybe 50 on up, why don't you play with it a little bit and come up with your your own rule for that consideration there. But that is something to keep in mind. The more liquid, the more option contracts are traded, the easier time you're going to have getting fills. Next thing we want to take into consideration is the tightness of the bid-ask spread. We'll go back in. Let's look at SPY again. Going back to the same option contract with 33 days to expiration. We'll pull it back down here to right around the money. So here's the bid. The bid is at $5.50. Here's the ask. It's at $5.53. So there's a 3-cent slippage right here. We see same thing, 3-cent slippage right here. A little more, same thing, 3-cent slippage. So, okay, now let's look at, contrast it with XRT as we've been doing. Still at that same 33 days to expiration. Look at this, bid, 72 cents, ask, $2.60. That's significantly a wider spread than 3 pennies. So basically what it is that if you sold the option for 72 cents and for some reason you had to close it the same day, you're going to pay around $2.60 to close it. You're going to pay more than you brought in. So like if you were planning on doing a day trade on this, which we're not talking about day trading here, but just to illustrate the example, you'd be losing a significant amount of money just in one day because of selecting a underlying asset that has a horrible bid-ask spread. So how tight do you want that? That's something that you are going to want to decide for yourself. Now, sometimes someone might say, "Well, Brent, I'm going to be selling cash secured put options on stocks that I want to own, so I don't plan on buying these contracts to close them. I'm letting them expire. They're either going to expire worthless or they're not, and I'm buying the underlying asset." And that is a fair argument, and that's why this is a consideration. You need to make this choice for yourself of how tight do you want that to be. Because under the idea of I'm gonna sell to open, and upon expiration it's gonna expire worthless, or I'm getting assigned. If that's what you're gonna do, then the tightness might not matter. However, maybe you want to have a tight bid-ask spread anyways, just in case you change your mind. So that's up to you. Consideration that you have to make for yourself. More shares or higher share price. So another thing that you want to consider is that when we are selling cash secured put options, we need to have enough cash in our account to buy a minimum of 100 shares. Because that's what a cash secured put option is that you have the cash to secure the position. So for example, we're looking at XRT right here. This strike price of $63. It's a strike price of $63 per share, but these option contracts deal with 100 shares. So in order to sell a cash secured put option at the $63 strike price, we need to have $6,300 in our account. If we don't have that, let's say we have $3,000, then we're not selling a cash secured put option. We're selling a naked put option. And this I Have Success channel is not about that. Doesn't mean that I don't do it. I definitely do it. However, that's not a good way to begin. When you're selling naked options, there's a lot of management involved. So the beauty of cash secured put options is there's less management. So let's say you have $10,000 in your account. Right? If you got $10,000. And you could sell one contract on XRT, because out of your 10,000, you are securing that contract with 6,300, leaving you a surplus of a little less than 4,000. And you would not be able to sell 2 contracts here, because if you did, one of those contracts would be naked. As we just discussed, that's not what we want to do at this moment, or at least for the strategy. And so should you try to take in this $68, or maybe you could get met in the middle? Should you try to take in a higher premium from selling one contract on a higher price stock? Or should you look for a stock that's maybe let's say $15? So that way one contract ties up $1,500 of your cash, and you could sell 4, 5 contracts. So you could get 6 contracts sold at a $15 strike price. So let's say the stock's kind of trading around 15, something like that, but your strike price 15. Maybe each contract is going to be less premium though, but you'll have more shares. So then when you're doing like the whole, if you end up doing kind of like the wheel strategy, with the wheel strategy is kind of like, let's say we buy at 63 and we're going to sell at 64. You make $1 per share from 63 to 64 is $1 times 100 shares, you make $100. Well, if you do the wheel strategy on a $15 stock, and you do $1 per share, but instead you have 900 shares, then obviously you're making $900 versus 1. So that's something to consider, how you want to do it. But sometimes people, they get turned off because maybe the premium on this $15 stock is, maybe it's only I don't know, you're getting filled at maybe $3. Oops, let's do $3 times 9 contracts. So you're looking at $27 total versus $68. So that's something that you need to decide for yourself, and it is, in my opinion, a very valid consideration, especially if you move into the wheel strategy. What is a wheel strategy? Watch that playlist that's at the 1 minute mark. Another consideration, dividends. Do you want to pick stocks that have dividends? If so, or pick a stock that has a dividend. If so, what dividend range are you going to go with? I wouldn't go, generally speaking, I mean, it does depend on the sector that you're in. Some sectors are prone to higher dividends, but on average, if you're getting above like I would say 3, maybe like 3 to 5 is kind of normal, and you can you should be able to find a good amount of stocks that are meeting a lot of this criteria. They're having let me go through all the criteria. When we go through all the criteria that we're going to go through, you should be able to find stocks that have a range of dividends from like, I don't know, 3 to 5% yield, that meet all these different criteria that we are going to talk about. But that's something that you want to consider. There's no real right or wrong with it. Me personally, I kind of have a hard time ever buying stocks that don't have a dividend. It's just something that I just love dividends. A lot of times people will say like, oh, that's only blah, blah, blah. Okay. And your point is what? Your point is like, it doesn't, that for whatever reason, like that just doesn't faze me, that you're like, oh, it's only this much. Like, I'm always ready to make more money than less. So if, someone wants to make less money, I know people say, oh, no one would want to make less money. Trust me, I've been I'm 46, and I've been a workaholic for about 15 years. There's a lot of people that want to make less money. They're 100% happy with making less money. So that's something you want to consider. Me personally, I try to find, I love stocks with a 3% dividend or higher. But sometimes I'm still doing stocks with less than 3%. There's some other things, but a lot of times when I'm running scans, I'm running for 3%. Free cash flow. Free cash flow. What is free cash flow? I pulled this off from Investopedia. Takeaways. So free cash flow refers to a company's available cash repaid to creditors as dividends and interest to investors. Management and investors can use free cash flow to determine a company's financial health. Yeah, that's pretty good, right? If there's no free cash flow, there might not be a dividend for you. Free cash flow reconciles net income by adjusting for non-cash expenses, changes in working capital, capital expenditures. Free cash flow can reveal problems in the fundamentals before they arise on the income statement as a supplemental tool for analysis. A positive free cash flow doesn't always indicate strong stock trend, as it is possible for a company's share performance to trend downwards. Absolutely true. I think some of the biggest things of why you want to have free cash flow as a consideration is, this one's a real big one right here. This makes it real easy. You can quickly use it to determine a company's financial health. Now, me personally, I like to know more about fundamental analysis than just using one thing. But this is one thing that I always look at. And for me personally, if a company doesn't have free cash flow, I basically don't do it. And the reason why is that even though my fundamental analysis I know more than just free cash flow, I'm not a master of fundamental analysis. And if you have a company that has negative free cash flow, it might be that they are a profitable, healthy company, but they're just investing their money differently. And so you really need to figure that out. You need to figure out if that's it, or if they're bleeding, if they're on slowly dying type of company. And so to make my life easy, if it doesn't have free cash flow, then I don't use it for this strategy. Also, this is really true and is exactly what I was just saying. It's a tool for analysis. It potentially can reveal problems. And if you don't know how to figure out if negative free cash flow is a problem or if it's not a problem, then maybe you should just stick with stocks that have positive free cash flow. And again, right here, it doesn't indicate that it's going to be an upward moving stock. But what it indicates is that you know for a fact the company has more money left over at the end of the month than it has bills going out. Just like you personally, right? Let's say you got you and your cousin Bob. If you, at the end of the month, have $1,000 left over each month, and your cousin Bob is $1,000 in the hole each month, who has better financial strength? Right? But maybe Bob looks like he has a lot of money because he's driving around in the Hummer with the spinning rims, and he's living in a big mansion and all this type of stuff. So from the outside, it looks like his performance is going up. And, you're achieving that by being real frugal, and it looks like your performance is going down. But when you look deeper, when you're able to do that fundamental analysis on you and your cousin Bob, you realize that your cousin Bob is just bleeding money. And sooner or later, he's going to be going down, possibly, right? So where can you quickly find this out? Well, right here, back again at your handy dandy Yahoo Finance. Let's take a look at two well-known companies. The first one we're going to look at is Apple. So obviously you put Apple in this search bar here. Apple pulls up. You're going to go under this tab right here, Financials. And then you're going to go on this tab right here, Cash Flow. And then you're going to go to the bottom here, free cash flow. Wow, look at this. Look at going all the way back to 2019. Positive free cash flow, positive free cash flow, positive. And it's not just a little bit, you know, it's like, that's a significant amount of positive free cash flow. So this tells me that this is a pretty financially strong company. I'd feel pretty safe owning shares of this stock at a price that I thought was a good bargain. But as far as this company at the moment having enough money to stick out through bad financial storms and things like that, yeah, they got plenty of money left over. This is you. This company is a representation of you having that extra $1,000 a month. Now let's take another look at a different company that's also really well known, and it also starts with an A. Amazon. So we're going to do the same thing. We put in the ticker symbol. Now we're going to go to financials. And then we're going to go under the cash flow tab. Go down to the bottom, free cash flow. Look at this. Look at that. Negative. Not just negative a little bit. Okay, positive here, quite a bit positive here, positive here. But 2021, what happened? Why all of a sudden is Amazon hemorrhaging? Or is it hemorrhaging? We don't know, right? But it's definitely negative. If we just look at a negative number, we could call that a hemorrhage. There is a negative almost $15 million there. Look at this. Now it's almost 17 million. Same thing. Trailing 12 months. Almost $17 million. Now, does that mean that this company has a big problem? Maybe. How do you figure it out? If you don't know how to figure out if this is a problem or if this is money that's somehow going somewhere else that's totally justifiable and it's actually going to make the company stronger in the future, if you don't know and you don't really want to spend the time to find out, then you could just quickly cross this one off your list and go with something that has free cash flow. It's a pretty simple indicator, but it's up for your consideration, right? You consider it. Obsolescence risk. This is I'm going to use this as kind of a catch-all term, and I couldn't come up with a term that's more fitting, so we're just using obsolescence risk. Obsolescence risk is the chance of something going obsolete. For example, the horse and buggy, right? That's a real common one, right? Before there was cars, there were horse-drawn carriages, and that fell victim to obsolescence risk. CDs fell victim to MP3s and downloadable music and streaming music and things like that. And before that, there was the cassette tapes. The cassette tapes fell victim to CDs. And before that, there were records. And the records fell victim to the cassette tape. Well, I guess actually it was the 8-track. Whatever, but I think you get my point here. So not only do you want to think about obsolescence risk, but in not just the way of technology, in maybe in a faddish way also, like for example, electric vehicles. So electric vehicles are kind of the rage right now, right? Or have been the rage in the past, and seems like some companies kind of like running into problems, like Nikola, you know, that one. I did sell options on that back in the day, but it was complete speculation, speculatively selling options. I did not want to take ownership of that stock, so that's an example of a stock that I personally wouldn't want to do for the strategy. I'd use a different strategy for it. And if you're a beginner, I'm not recommending that you do that. So how about now we got the AI craze going on? Are all companies going to be around and going to be profitable just because they claim that they're AI? Maybe they even are AI companies. So just you want to consider some things. Like, now what are some companies that probably won't be going away? Well, how about cement companies? You think cement is somehow going to be replaced? It's been around for a long time. It's kind of it's not really a fad. It's kind of needed for a lot of things. How about steel? How about iron? How about aluminum? How about eggs? How about dairy? How about any type of food type stuff? How about just sort of basic essentials? And so those are just things to consider, right? There is no, I don't know if there's a right or wrong with it. I don't know if there's a right or wrong with any of this stuff. It's all just considerations for you to make for yourself, to have a better idea of how to pick one stock or more to sell cash secured put options on, and that if you get assigned, which you probably will sooner or later, that then you can kind of feel rest assured that if you're stuck with this stock for a while, like if it's very liquid and your contracts are real liquid, maybe you won't be stuck with it because you have an easier time getting out of it. But if you are stuck with it for a while, which I have been in the past, stuck with one stock for a year and a half because it was below the price that I bought it at. It took a year and a half for it to get back up and go over the price that I bought it. You want it to be a company that's going to be around, and because that company paid a pretty healthy dividend between receiving dividends and selling option premium, I cash flowed that stock about I think it was like $1,500. The whole time the stock was trading lower than the price that I bought it at. Was that an ideal situation? No, it wasn't. But I built safeguards around myself that even in an unideal situation, I was still profiting. And that's how I like to do this strategy. Now, there's other strategies that I do that doesn't, it's not that safe, but this strategy, I feel like for me is very safe. There's always risk involved, but when, just like getting into the boxing ring, there's always a risk involved, right? There's always risk. No matter how much you train, no matter this, no matter that, there's always some risk, right? That's part of the game. And so this strategy, I feel, for me, making wise selections on these considerations, I feel it does a good job of keeping me, helping me mitigate that risk. So let's end this video with taking a quick look at what's going on in this paper trading account here. We had, I had a variety of put options sold on this. Maybe I had 2 of them. I actually had a covered call, which means since I have 100 shares of stock here on XLU, this is a utilities ETF, I had 1 covered call sold. I think I also had a cash secured put option sold, and on XLK technology ETF, I had a cash secured put option sold. But all those options expired worthless, so I just kept all that premium. Now it's time to look at selling at least the covered call. Let's take a quick look at the chart of XLU. This is a 6-month daily chart. So we're seeing 6 months of data here with each of these candles being 1 day. Let's move over here to look at the weekly chart. This is each candle is 1 week, and we're looking at 5 years of data. So what I'm quickly noticing right here is at this about $65 mark, it seems to be a bit of resistance here. And what price did I buy this at? I think it was at 67. And on the upward side, we definitely see something here at the 70, probably right in there. So let's look. Something I want to take note of real quick. In this little range from like here to here, see how it after it dropped down here, it went up to about here and pulled back. So now we're looking at a little bit of range right here. Each one of these candles being 1 week. Look at how high it got up here, but it opened and closed way down here. So it's really testing this $65 range right here. So what I'm gonna do, I'm gonna put a little extra risk on the table here, possibly. Let's take a look at maybe selling we bought the stock for 67. I was thinking about maybe selling a $67 call. Let's at least look at the premium. This contract has 5 days to expiration. $67 call. See this column delta? Delta is kind of a somewhat it's not the most accurate, but it's basically giving me a quick and dirty idea that there's about a, based on the however the algorithms are set up and that type of thing, there's about a 12% chance that in the next 5 days that this stock XLU will be trading at or above 67. And talk about our volume, right? We got a lot of volume over here. Open interest, a little bit over 1,000, 500 on the volume. Right here, the high that it traded for was 12 bucks, 12 cents times 100, so 12 bucks. Low was 4. Look at this bid-ask spread, not too good, huh? That's a pretty wide bid-ask spread. It's not as bad as XRT, but it's definitely not the 3 pennies tight like SPY. So let's do this. Why don't I I could go, if I go for the 67.50, then look at that. Really, you see that, how the chance really breaks down? Let's look at the chart and see that. Right, 67 is hitting right there. 67.50, not so much. So why don't we do this? Let's look at going the next option contract 12 days out and look at 67.50. Okay, now we're back to about a 12% chance of getting a sign. We got lots of open interest. Good amount of volume. Highest it sold for was 17 cents. I'm going to put an order in, and I'm going to click this on the bid side. Bid is to sell, ask is to buy. If you can't remember which one, you always sell at the lowest price, you always buy at the highest price. Why is that? It's not fair, all that stuff. Don't get into that. Just think everything is fair. That's the way that it is. Boom. Now, I'm talking about in the context of trading. Because I'll tell you what, everything is not fair. If you politically connected, you get some hookup. And what was that? What was that? 17. So what I'm going to do is I'm going to put this to 17 cents. I'm going to change this to good till cancel. This order confirmation, I have this set up. I'm going to put this under here like that because that's how I do it. Boom. I'm sending that one in. So now I'm going to try to get filled at the current price is about 11 cents. Trying to get filled at 17. So if the stock rallies up a bit, we might get filled at 17. We'll see. No big deal if it does or doesn't. If it does, that's great. If it doesn't, no problem. And let's also, on that same stock, let's put in an order to buy another 100 shares, but not just straight out buy them. How about selling a cash secured put option to buy? So this is something we can do, right? We see that there's when we looked at I think it was the weekly. Look at this, around the $65 area. Right? See how prices kind of react? Even going back here, look at that. They get up to almost past 65, couldn't. And then eventually it did. But look at that, how it kept hitting its head on that. Look at right there. Boom, boom, boom. Trying to get above 65, can't. Pulls back. Trying to get 65, can't. Finally does it. And then obviously it drops down. And then eventually over here it's back around that $65 area again. It breaks out above, but it's a breakout point and failure. Boom, back below. Staying below. Over here, oh, it gets above, oh, but it can't maintain it. It's back below, but not too much below. And then it gets above, then it's right back here around 65. And then it goes all the way up here. Then it comes back here and tests that 65 again. Then it goes all the way up here and it comes back here and tests that 65 again. Then it goes all the way up here. Then it drops down a bit below that 65, rallies up over here. And then what didn't you know? We're back to testing that 65. And then we're over here. And then look at this. We're back to testing the 65. So there's something about the $65 price that kind of bounces around. So what I'm going to do is I'm going to put an order in for the $65 strike price, and on the same expiration date, 12 days. Because look at this is a pretend account. I got lots of money in it, lots of monopoly money in there. So I got enough money to buy another 100 shares. I'm totally okay with buying another 100 shares, or I'm totally okay with not buying another 100 shares because I'm going to get paid something, maybe around $50. Look at the highest this sold for was 60. So I'm going to put an order in for 60, see if I can get paid $60. And one of two things will happen at the end of 12 days. It'll either, the stock price will either be above 65, like it is now, even if it's at 65.39, then my contract expires worthless and I keep that $60. If it's below 65, then I keep the $60 and I buy another 100 shares of XLU for 65. I already have 100 shares at 67. If I add another, hold on, I do it this way. I'm not the greatest at math. Okay, so I had 6,700 put in there, put another 6,500 put in there. And so it's a total there divided by 200 shares. So it drops down my cost basis to 66. Now with hindsight, I should have been able to figure that out mentally, but like I said, I'm not really that good at math. I'm getting better every day. 65, 67, 66 is between it. Okay, it was kind of silly that I need to use a calculator for that, but good thing calculators are around. So anyways, drops down my cost basis, and then what I'll do is instead of selling one covered call option, I'll sell two. I love how this snowballs, man. I really, really love this strategy. I'm telling you, I absolutely love doing this. So I'm gonna put this order in, right? Bid, ask. I'm clicking on the bid. If I forget which one is the buy and which one is the sell, it's very easy to remember. Sell the lower number, buy the higher number. So I'm clicking to sell, and let's say I made a mistake. At least with Thinkorswim. Let's say I click this one. No problem. All I do is come over here. Right, I see it's buy. I just do this. Change it. No problem. And I'm going to change this to $60. Put in good till cancel. Change this over here to long stock. And send it in. Now, technically, I'm trying to open a short strangle on this stock to buy more shares, get rid of shares, whatever. I'm just bringing in money, just making money, just making money, just making money. Might not be a whole lot of money, but it all adds up, and it's pretty difficult to lose money. So that's what I like. I like doing that. Looks like we got about a little bit less than a 12% chance of the stock getting called away from us, and we got a little less than a 43% chance that we'll be buying more shares at this price. We're going to end it with that, ladies and gentlemen. We got those considerations, and remember, we got the how many stocks should you trade. I would suggest, if you're really beginner, find a stock that fits this criteria that you like and start off with one. Volume, maybe look for a minimum of 500,000, a million, something like that, but you make that decision for yourself. Volume of option contracts, you're going to have to make that decision for yourself. You see it can kind of vary. Tightness of the bid-ask spread, you see that can really vary. You're going to have to make that decision for yourself. And I'll leave it at that. And then should you go with more shares at a lower price stock, or should you do less shares at a higher price stock so you can maybe get more premium? You're going to have to make that decision for yourself. Dividends, if you want to make sure that the stock has dividends, if so, what range of dividend? By the way, if generally speaking, if a stock is like over 6% dividends and it's not normal for that industry, then it's probably giving you an indication of a red flag. So if you're kind of sticking between 3 to 5, you're probably in a safe range. But what's always good to do is take a quick look at maybe what sector that stock is in, and then and then see what's normal for that. I don't quickly remember how to find out different sectors, just I think mainly because why is that? Because normally the way I find stocks, I either mainly, number one, certain stocks I just trade all the time. I already know what sectors they're in, and I've been trading them for a long time. Another thing is when I'm investing, which is obviously different than trading, then I do searches a certain way, and I screen for certain industries. So I don't know how to go backwards at the moment. I guess you could just kind of look to see what's similar. Now you're gonna have to figure that one out for yourself. Let me know when you figure that out. Free cash flow. Do you want free cash flow? Do you not care? Are you gonna become a wizard at fundamental analysis so you can figure out if there's negative free cash flow is actually hemorrhaging money, or are they putting that money to productive use somewhere? Obsolescence risk and those type of things. The general type of company you're getting. You're gonna have to figure out kind of see what you like, and I think what you should also like is you should like this video. Just hit the thumbs up button for me. If you don't want to, I don't care. Don't do it. You do whatever you want to do. That's the most important thing. Is you do you, as long as you're not hurting other people physically or mentally or emotionally. Have a fantastic weekend, Aloha.